Every year, thousands of skilled workers come to the United States on H-1B visas. But one question almost every H-1B professional has is this: how exactly are you taxed in America? Do you pay the same rates as US citizens? Do you get the same deductions? And what happens if you fail the residency test? Let's break it down clearly. If you're working in the United States on an H-1B visa, you're required to pay US federal, state, and local taxes, just like a US citizen. Most H-1B workers end up paying 25–35% of their income in federal income tax. State income tax varies by state. Local taxes depending on the city. Social Security and Medicare contributions. And while living in the US, you may also pay property tax, sales tax, capital gains tax, estate or inheritance tax, hotel lodging tax, gas tax, and other local fees. But how you file depends on your tax residency status. Which is different from your immigration status. US immigration law and US tax law treat residency differently. For tax purposes, there are only two categories: resident aliens, taxed like US citizens on worldwide income; non-resident aliens, taxed only on US-sourced income. So, how do you know which one you are? It all comes down to the substantial presence test, a day-counting formula that looks at your physical presence over 3 years. To qualify as a US tax resident, you must be in the US for 31 days this year and 183 days over 3 years, calculated as all days in the current year, 1/3 of the days from last year, 1/6 of the days from 2 years ago. Even part of a day counts. Example: if you spend 122 days in the US each year for 3 straight years, you'll meet the test. Most H-1B workers end up becoming US resident taxpayers under this rule. Scenario 1. Arrive before July 2nd, Year 1. If you enter the US on or before July 2nd and stay through December 31st, you will exceed 183 days that year. You become a US tax resident in Year 1. Your residency start date is your first day of arrival. Scenario 2. Arrive on July 3rd or later, Year 1. You will only be present for 182 days, so you do not meet the substantial presence test. You are a non-resident alien for Year 1. But if you stay at least 122 days in Year 2, you'll become a tax resident starting from the first day you enter in Year 2. If you are a non-resident alien, fail the test, you only pay tax on US income. You must file Form 1040-NR. You cannot claim most deductions that US residents use. If you become a resident alien, pass the test. You pay tax on worldwide income. You can file Form 1040. You can claim standard deductions and credits available to residents. Some H-1B workers who fail the test may still choose to be treated as residents for certain years, depending on circumstances. Many H-1B workers are considered residents under US tax law and residents of their home country under its tax rules. This creates a dual resident taxpayer situation. To prevent double taxation, US tax treaties include tiebreaker rules, which determine which country you are officially considered a resident of, which country gets priority in taxing your income. These treaties ensure you aren't taxed twice on the same earnings. Taxation for H-1B workers can seem complex, but it all comes down to one key principle. Your tax residency, not your visa, determines how you file and how much you pay. If you understand the substantial presence test and know whether you're a resident or non-resident for tax purposes, you can file correctly and avoid penalties.